Well, amidst elections, let's talk about earnings as well. Strong Q2 performance by Lumax. The management revised FY26 revenue growth guidance upwards from 20% earlier to 25%. Puneet spoke to Anmol Jain, the MD of the company. Listen in.
First question largely on what we see in this quarter, post the GST rationalization. For the full year, you've actually come out and upgraded your guidance from a 20% growth to a 25% growth. What are you currently seeing on the ground that's giving you the positive momentum to increase that guidance for now?
So thank you for having me. So there are two fundamental reasons why the growth estimates or the guidance for the current year will increase. Number one, of course, after the GST reduction, we are seeing a stronger demand from across different OEMs. And this trend, we expect it to continue not just in Q3, but even until Q4. So that's one reason. But primarily, the reason is that we are sitting on a very strong order book. So a lot of the new product introductions, new launches, which were recently made in Q2, we will get the full half-year effect of that in Q3 and Q4. So that's what's going to be driving growth going forward in H2 as well, and hence we revised our guidance for the full year.
The second question, Mr. Jain, in terms of largely this growth, which segment do you think that it will be driven from? Because you also have IAC, which you had acquired a couple of years ago. Green Fuel is helping you with boosting demand for CNG products. Where do you expect that growth momentum to come from specifically, or is it largely broad-based growth across segments for you?
So for us, let's say the order book, which is the company is sitting on almost roughly 1,350 crores, 80% of that is actually in the passenger vehicle space. So we do expect a lot more traction of the new models, new products coming into the passenger vehicle space for the company. And again, IAC being almost close to 40% of the order book largely caters to the passenger vehicle segment. So between two-wheeler will also continue to grow for us in absolute amount, but definitely the performance of passenger vehicle piece of the pie for us will be far more than any other segment.
With the growth guidance now upwards, revised essentially for FY26, is there any upside risk to margins as well? You've guided for roughly 14 to 15% for FY26. You also have the higher margin IAC amongst others now being recorded in the numbers. So should there be an upside risk towards higher than the 15% number?
No, I think for the full year, the guidance would be pretty much intact. As you mentioned, it would be between 14 to 15% EBITDA margin. I think for H1, the company has already delivered a margin of 14%. And again, I think in H2, we do expect that margin to be slightly better than H1, backed by these new product introductions, new model launches, and also a revival in the aftermarket business. H1 aftermarket stood at about a 14% growth. In H2, we are expected to have a even higher growth for the aftermarket. So all in all, we are looking at between 14 to 15% for the full year, and hence, H2 should fare better than H1.
Okay, first rates ticking in.